Once upon a time, what Wall Street called shareholder value clearly meant manipulation. If a company burned its own cash just to inflate the price of its own shares, that wasn't financial genius. It was fraud. Executives could be arrested, companies could face heavy penalties, reputations could be destroyed. Today, everything is completely different. Stock buybacks, a company purchasing its own shares to push the price higher, have become the most powerful engine of corporate America. They lift markets, inflate CEO bonuses, and quietly transfer trillions of dollars to shareholders, without a single new product created or a single new job added. So how did something once considered a crime become the backbone of modern capitalism? Welcome to The Financial Historian, where money, power, and history collide, and where nothing is ever as simple as it looks. H2, Chapter 1, Origins, a story that begins with a collapse. The story of stock buybacks begins with a collapse. In the roaring 1920s, markets were casinos. Executives manipulated their own stock prices. Bankers made insider deals. Fortunes appeared and vanished overnight. The New York Stock Exchange was a theater of illusion, and everyone wanted the starring role. When the crash came in 1929, the very tricks that had fueled the illusion turned deadly. Companies had emptied their coffers, buying their own shares to hold prices up, giving investors a false sense of safety. As panic grew, those same companies began selling shares to stay alive, accelerating the collapse. By 1933, confidence in capitalism was gone. Factories shut down. Banks failed. Unemployment hit 25%. The public no longer trusted Wall Street or the idea of a free market. H2, Chapter 2, 1934, the era when manipulation was a crime. Strong. A dang crime. The Roosevelt administration did something radical. It rewrote the rules of capitalism and made one thing unmistakably clear. Strong. Companies manipulating their own stock prices would no longer be tolerated. The logic was simple. The market was supposed to reflect value, not vanity. For the next 50 years, stock buybacks were effectively illegal, not by name, but by definition. If a company bought its own shares to influence the price, it could be prosecuted. And during this time, the American economy grew without this trick. Companies invested profits into research, factories, and workers. CEOs were builders, not traders. The stock market measured industrial strength, not mathematical makeup. The system wasn't perfect, but it was productive. Hey, Chapter 3, one idea changes everything. Shareholder value. In then, 1970s, a quiet revolution began. Not in factories, but in universities. Economists like Milton Friedman argued that a company's only responsibility was to increase shareholder value. For executives, this was liberation. No more being judged on stability, employment, or long-term growth. There was only one metric now: the stock price. In the 1980s, the Reagan era arrived, the age of deregulation, free markets, and Wall Street's rise. Investors wanted higher returns. CEOs wanted more flexibility. Corporations wanted a way to lift stock prices without waiting for real growth. They didn't want to change what they built. They wanted to change what it looked like. Chapter 4, 1982, the one-page rule that rewired capitalism. The SEC quietly introduced a one-page regulation called Rule 10b-18. This rule created a safe harbor. As long as companies stayed within some loose daily limits, buybacks would no longer be considered manipulation. No congressional debate, no public hearings, just a silent rule change in the middle of the Reagan Revolution. With one stroke, what had been banned for generations became legal. companies could now inflate their own stock prices, as long as they called it returning value to shareholders. The impact was immediate and seismic. Chapter 5. The Boom. The Age of Buybacks. Before 1982, companies rarely bought back their own shares. They paid dividends and invested in growth. After 1982, in the 1990s, buybacks passed $100 billion. In the 2000s, they became routine. By the 2010s, they exceeded $1 trillion a year. The logic was simple. Buying back shares equals reducing the number of shares in circulation. Fewer shares equals higher earnings per share automatically. Even if total profits stayed the same, the company appeared more profitable. Stock prices rose. Executive stock-based bonuses skyrocketed. No new products, no new jobs, just math. This wasn't capitalism. This was accounting turned into alchemy. Chapter 6. After 2008, the illusion peaks. After the 2008 financial crisis, banks were bailed out with public money. Then those same banks used their profits and even borrowed money to buy back their own shares. Between 2009 and 2019, S&P 500 companies spent strong $6 trillion on buybacks. More than they spent on new investment. Buybacks don't build resilience. They build illusions. Chapter 7. Inequality, Dependency, and the Risk of Collapse. Buybacks funnel wealth upward. In the U.S., the richest 10% own almost 90% of all the gains from buybacks. Workers' wages stagnate. Savings shrink. Costs climb. Companies no longer operate to produce, but to inflate their stock price. The economy has turned inward. Corporations feeding on themselves. And the system has become addicted. When buybacks stop, markets fall. To prevent that, companies borrow money to keep buying shares. Between 2010 and 2020, corporate debt doubled. This isn't just finance. It's ideology, a system that values appearance over reality. Chapter 8. History repeats itself, just like the 1920s. Cheap money, inflated stocks, blind faith in endless growth. And just like the 1920s, the warnings are everywhere. When a system rewards appearance over productivity, when it worships price over value, when capital stops circulating and concentrates at the top, the collapse becomes a matter of timing. Final word, when the illusion breaks. Buybacks were once a crime. Then they became the legalized form of manipulation, rebranded as efficiency. That isn't progress. It's regression dressed as sophistication. And the most expensive illusion isn't a bubble. It's belief. Belief that numbers on a screen are the same as real wealth. Belief that manipulation equals growth. When that belief breaks, only the naked truth will remain. Buybacks are not capitalism. They are choreography. A dance designed to make decline look like success. If this gave you a new perspective, don't forget to subscribe. History has the answers, and I'll show you where to look.